Welcome to this visual explainer. Today we're tackling a massive, honestly pretty mind-blowing premise that completely flips traditional financial advice right on its head. See, the biggest barrier to building incredible, life-changing wealth, it actually isn't a lack of complex financial knowledge. It's not that you picked the wrong ETF, and it's certainly not because you don't have a PhD in macroeconomics. No, the real enemy here, it's our own brains.
Okay, let's dive into this with a question that, well, it might sting a little bit, but it's meant to challenge your ego right out of the gate. Why aren't you getting rich? Think about it. We so often want to blame external factors, right? The market, the economy, whatever. But the truth? It usually lies within our own daily choices. Most people mistakenly believe they're poor because they just don't understand the stock market or interest rates. They think it's technical ignorance, but it's really not. The reality is that people fall for deeply rooted psychological biases. And these biases are incredibly dangerous because they wear a disguise. They disguise themselves as adult, safe, and prudent decisions. They feel like plain old common sense, but behind the scenes, they are quietly eroding your long-term capital. To fix this, we've got a clear roadmap for you today. We're going to debunk 5 incredibly common financial illusions: the false common sense, cash flow versus total return, the illusion of safety, optimizing income first, the real estate dogma, and finally, winning by making fewer mistakes. Let's get right into it. Section 1. The false common sense. These are the financial decisions that just feel right, but really aren't.
Moving on to Section 2. Cash flow versus total return. Basically, the yield trap.
So, our brains have this dangerous, almost dopamine-driven addiction to visible cash flow. You know the feeling, like seeing a deposit hit your bank account. It feels great, but we need to define our terms clearly here. Yield is simply the income generated and distributed to you. Total return, on the other hand, is the overall variation of your wealth after inflation, costs, and taxes. And guess what? Total return is literally the only metric that matters. I can't stress this enough. Dividends are not free money. When a company pays a 3% dividend, the stock price adjusts downward by exactly 3%. You're really just moving wealth from the company's value directly into your own taxable pocket. And this brilliantly illustrates the trap: 8.34%. This is the incredibly tempting yield from a prominent JP Morgan income ETF based on the MSCI World Index. I mean, who wouldn't want a guaranteed 8% hitting their account every single year? It sounds like an absolute dream come true, right? But wait for it, here is the devastating catch. For the comforting placebo of that constant income, you're actually sacrificing the real growth of the asset. You see, the fund pays you by capping your upside. If the market absolutely soars, you miss out entirely on those massive gains because they get traded away just to pay your yield. But if the market crashes, you still take the full hit. No protection there. The total return of this high-yield product ended up being only a quarter of the underlying index it tracked. Essentially, you bought a placebo, not a wealth builder. Which brings us to Section 3, the illusion of safety, or, as I like to call it, paying way too much for prudence. This whole idea stems from a total misunderstanding of what prudence actually means. Prudence isn't about avoiding all risk by, say, burying your cash under a mattress. There is a massive fundamental difference between a nominal guarantee and a real guarantee. When people tell me they want a guaranteed safe investment, they usually mean they want their nominal euros or dollars to stay perfectly intact on a screen. But a real guarantee? That means ensuring that money can actually buy the exact same amount of goods 10 or 20 years from now. Let's put that into perspective. If you bought a 2021 government bond yielding a guaranteed 1%, you probably felt pretty safe. But over the next 5 years, inflation averaged 4.5%. So that safe investment, it actually locked you into a 20% loss of your real purchasing power. Yeah, sure, you avoided market volatility, but you basically built yourself a prison of guaranteed negative returns. The true risk isn't your portfolio fluctuating today. It's waking up tomorrow and not having enough purchasing power to survive. All right, Section 4, optimize income first. The danger of not earning enough. So the crucial point here is that instead of obsessing over tweaking the investment portfolio, we really need to look at the investor. Look at these 2 30-year plans. On one side, you invest $600 a month at a very standard, totally realistic 5% return. On the other side, you invest only $300 a month, but you chase this incredibly aggressive 9% return. Who wins? The person contributing more money wins handily and with way less stress. Increasing your monthly contribution is a mechanical choice that is completely within your control. Trying to force a 9% return out of the market? Well, that's essentially just gambling.
It's time for a little tough love from financial writer Nick Maggioli. He says, as long as your portfolio's expected return is less than your investable savings, you must focus on your income. Look, if you're spending hours trying to save $30 in portfolio fees, but your wealth engine has barely any fuel, you are totally wasting your time. Upskilling, negotiating a raise, or starting a side hustle, that is absolutely where your early focus belongs.
Section 5. The Real Estate Dogma. The obsession with buying at all costs.
We are literally conditioned from birth to believe that renting is just throwing money out the window, right? But let's break down that illusion. A house comes with taxes, constant maintenance, insurance, an immense lack of liquidity, geographical risk, and absolutely zero diversification. A house you live in is primarily a durable consumer good that constantly drains cash. It is absolutely not an automatic, risk-free investment. Think about it. Tying up 80 to 90% of your entire net worth in a single illiquid asset? That's the exact opposite of safe diversification.
Here is a very pragmatic rule of thumb to follow instead. If you plan to stay somewhere for less than 5 years, renting buys you crucial flexibility, and it allows you to invest your down payment capital directly into the market. Now, if you're staying for over 10 years, okay, buying might start to make some financial sense. But when you're young, restricting your career mobility to a single zip code just because you bought a house, because that's what adults do, can cost you massive career and income opportunities.
Okay, on to our final section, Section 6, Winning by Making Fewer Mistakes, How to Avoid the Ultimate Trap.
Our final error is this widespread illusion that understanding the economy somehow means you can predict the stock market. Really intelligent people fall for this all the time. You read the news, you see inflation and war, and you think to yourself, yikes, it's a terrible time to invest. But markets don't react to today's news, they react to the difference between the news and future expectations. They are entirely forward-looking. Stopping your investments just because the news looks bad, that is a catastrophic error.
Let's move to a real example and see how this builds. Just think back to 2022. We had war, massive inflation, and the market dropped 18%. The media was practically screaming about disaster, and countless smart investors, they pulled their money out, waiting for things to just calm down. But what happened next? Between 2023 and 2025, the global market soared over 60%. If you hit pause during the panic, you completely missed out on the massive rally that followed.
To bring everything we've talked about together, remember this fantastic point from Charles Ellis. Investing is like a game of amateur tennis. The winner is the one who makes the fewest mistakes. Personal finance isn't some race to see who has the smartest, most complex insights. True wealth isn't built by brilliant market timing or discovering a secret ETF. It is built by avoiding these unforced cognitive errors, keeping things incredibly simple, investing consistently, and just letting time do the heavy lifting for 30 years.
So as we wrap up this visual explainer, I want to leave you with one final provocative question. What is your next financial move? Now that you can clearly see how your brain's desire for false safety and constant cash flow is holding you back, what are you going to change? Challenge your biases, focus on growing your income, and stay the course. Thank you so much for joining me on this explainer. Now go out there and make some rational wealth-building moves.